Welcome to the ASA podcast, where we focus on subcontractors, the construction industry, and the issues and people making an impact. The ASA podcast is brought to you by the American Subcontractors Association and the Foundation of the American Subcontractors Association. All right, welcome everybody. Welcome back to another episode of the ASA podcast. I'm your host, Mike Klein, and joining me today is Nick Napolitano. Nick is with Assured Partners. And he's here today to talk about group captive insurance programs. So welcome to the show, Nick. Why don't you tell us a little bit about yourself and Assured Partners, and then we'll just dive in.
Sounds great. And thanks for having me, Michael. Appreciate the time. So as Michael suggested, my name is Nick Napolitano. I currently run the national captive insurance practice at Assured Partners, where we, service hundreds of construction clients and over 500 captive insurance clients and various types of captives. Today, we're going to talk about primarily member-owned group captives. I've been in the industry really my entire career, 15 years, with the last decade spent exclusively in the captive insurance space.
Cool. Excellent. Well, I mean, the big question I have just to kick off is, what is a group captive insurance program? Can you define that for us?
Sure. So truly a group captive insurance program is it's an alternative risk strategy. And when I say alternative, it's alternative to what traditional insurance buying is. Okay. So you're taking on as a group, first off, you're selecting the top 25 to 30% of the marketplace in terms of performers. Okay. This is the philosophy behind it. Okay. When I say performers, I don't necessarily mean the most profitable, although that is part of the underwriting requirement, but really it's the safest, right? And that's really quantified and qualified in two ways. Okay, quantifiably, it's kind of looking at what is the premium that you've paid in versus the losses or claims that have been paid out, typically over a 5-year evaluation window, right? And then qualitatively, it's an interview process and a scorecard. How does your company stack up with the rest of the marketplace? So if you kind of fit into that top 25 or 30% of the marketplace, we segment it out, create a group captive. There's homogeneous group captives specifically for construction. Then there's heterogeneous captives that are a hodgepodge of different industries, which could include construction, in addition to having geographical spread. The group takes on some risk and then reinsures or insures away some risks on the larger claims so that it's a tolerable level of risk. The goal of a group captive, truly, in one sentence, is to drive down the cost of the members relative to what traditional insurance would be. I would say it's an elite program because, frankly, just not everyone's going to qualify because they're not putting in the hard work and they're not investing the dollars in, employee retention, safety and risk management, claims management practices that truly do drive best in class results, which really can be identified in a number of ways. I think when you talk about a group captive, Michael, you really think about, can the member, or if I'm sitting there as an owner of a $50 million construction company that's paying $1 million a year in premium, can I control my frequency to a fairly high degree over the long haul, my frequency of claims? If I can do that, then you would do very well in a group captive. That's really kind of who we're looking for. That's who benefits the most, and that's really who the programs are designed for.
Okay. You mentioned a couple of types. What are the various types?
Yeah, so I mentioned, again, homogeneous, again, just being all of one industry, right? So, for example, there's a captive called Roofers Insurance, okay? As you can imagine, it's all commercial roofers, and it's big. There's like 150 members nationwide. Then there's homogeneous groups that are a little bit broader. So it might have just all types of construction. Then you have heterogeneous, where you can have construction companies in a group captive alongside with manufacturers and distributors, retailers, and so forth. Beyond that, There are many different captives. Okay. So there's different captive managers. The market has really evolved and responded over the last, let's say, decade, although this product has been out for, over 30 years. So there's a very much a market leader in the space, but then there are other smaller competitors that, have niches that also do a great job. So it's not as cut and dry as it used to be, but that's a good thing because there's more optionality out there and there's more value to be had as long as you know kind of how to evaluate the landscape properly and select the right captive.
So in terms of obviously ASA is an association of subcontractors. Is there a certain captive type or structure that is best suited for middle market construction companies that are primarily acting as subcontractors?
Yeah, Michael. Frankly, there's a bunch. It really depends on what you're doing specifically. I would even say it depends on size, maybe to a lesser degree location. Like there's challenging states, right? Like New York, California, Florida, right. Louisiana. Those are challenging states. However, with that said, for the most part, there will be a captive solution in really every geography in the construction space. I would say largely outside of the 5 boroughs of New York City. But again, that's certainly part of the evaluation process is, hey, what are we doing? And who do we want to be in business with? Who do we want to share risk with? Although risk sharing is not a huge, I described it as not a huge financial component to the captive, but there is risk sharing involved. So, to me, as somebody that's constantly stewarding new members joining and becoming part of the group, I think it's a really kind of in-depth, almost philosophical conversation that needs to be had to decide who do I want to be with. So I think that's a great follow-up question.
That's good. So I'm assuming that how did group captives come to be? There's got to be an origin story to this.
Yeah, it's interesting. I mean, it was necessity is the mother of all invention, and I think that's true here. I mean, it really predates me. So about 35 and maybe even 40 years ago now, actually a group of manufacturers, I believe in the Midwest, came together and really developed this concept. And it hasn't changed. It looks similar to what it did when it was originated 35, 40 years ago. And that original captive still exists. It's the largest group captive in the world with, I don't know, I believe over 500 members, across all industries. It's heterogeneous. And so that gentleman that started the captive, who really is owed a lot of credit, he went and got into the captive insurance business. And now, he drove the market leader who controls about 80% of the market. So really, really neat origin story there.
Yeah, that's pretty cool.
Yeah.
Yeah. So what are the main criteria that would make a construction company an ideal candidate for a captive?
Yeah, great question. So let's kind of start with size, right? We really look at it from the standpoint of premium size, not gross revenue of the company. Premium size, and you could get varying answers, I would say, from insurance professionals. I would say a couple $100,000 in premium is where where it really starts to make sense, where you can have some real significant return on investment. I would say, at least 5 years in business. Top performer, like I mentioned earlier, is really going to be the main driver. And one way that, just back to the napkin math, if you're listening to this and you're saying, well, are we in that ballpark? Well, if you look at the premium you've paid over the last 5 years, and then you look at the claims paid out, right? And you just kind of develop your own kind of gross loss ratio. If it's under 40%, means you're probably going to be a good candidate, right? So this is how the math breaks down. Got about 35% overhead to run any type of insurance company, whether it's Travelers, Hartford, or a group captive. It's about 35%. Then you bake in another 40% for losses of claims actually paid out. And as you'll see, okay, we're up to 75%. Well, then you've got 25% profit plus investment income. So that's when it starts to really make sense. Now, we deal with some companies that have a loss ratio that's in the teens, sometimes single digits. Obviously, that's what you'd consider really a slam dunk or a home run because the financials are just going to work out incredibly well. In addition, there is some financial underwriting. I would call it very basic financial underwriting that occurs, just a tertiary review of the last couple of years of financials. Just looking for, financial general strength, ability to pay bills, having the ratios be what they are. I would say for, most companies in my experience that do a real nice job with risk management tend to be a bit more conservative financially and are in a pretty strong position. So that's typically not a barrier. And then, lastly, and again, I'm drawing really from my experience here. This isn't written anywhere. This isn't a hard and fast rule. But I think family-owned, multi-generational businesses really tend to thrive in captives over, let's say, like private equity-backed firms that, may flip ownership every 3 to 5 years, because the appeal, I just don't think is as deep for those folks. That's not to say that private equity-backed firms can't join captives, because they certainly can, and they do. And, they're obviously, smart people that typically are behind those looking to cut costs. But it, I think, changes the calculus a bit when you're, posting collateral that you have to figure out what to do with in every 3 to 5 years. So to me, those are, really ideally who we like to see, joining captives, and who's going to join them for the long haul, right? This is very much a long-term play. Not because you have golden handcuffs. You can join a captive and 12 months later you can leave a captive without a penalty, but their retention is 99% roughly, right? And the reason for that is if the new member is educated correctly, you're getting into it for the long haul. Plus you're picking up some additional control that you haven't had in the past. And it's tough to give that up. I mean, if you find yourself in a better position, you tend to stay there.
Have you had, in your experience, have you had any issues with, obviously if you've got companies that are in the same space, they're going to be competitors. And you could be, these folks could be in a position of relying on their competitor in the same pool. Is that generally a problem?
That's another great question. So we certainly have ran into that. We've also ran into scenarios where competitors say, listen, I know that, Johnny's Plumbing down the street is in this captive. I do not want to be in the captive. Maybe they're not friendly competitors, or they just don't believe in each other, whatever the case may be. And we can accommodate typically. I mean, I'm not going to say it's rare that we would have competitors in the same captive. I would say it's more rare that they have a huge preference that they would not want to be in the same captive.
Okay.
But hey, over the years we've ran into a lot of interesting things. That being one of them.
Yeah, now that makes sense.
Yeah.
So if you are a construction company, how do you go about learning about captives or exploring captive solutions? And so on top of that, how do you determine if it's a good fit, a captive solution, and how long does the process take?
Yeah, right. So this is a fairly esoteric corner of the insurance industry. Okay. Again, my opinion. Like if you look at our organization, just using it as an example, this isn't a commercial for us, but as an example, we've got 11,000 employees, right? Well, we may only have 30 employees out of those 11,000 that are truly fluent in this language, because it's a niche space, right? It's just a slice of the industry. So my point in saying that is I think finding a broker that really has experience and has several clients, a dozen clients, or dozens of clients at least, or hundreds or whatnot in their agency really helps, because the educational process needs to be really the cornerstone of this, because as a new member, you've got to understand the pros and the cons, because there's risk reward continuum here that needs to truly be understood. Now, it can be embraced and it can be a very powerful tool, but there are aspects to the captive that are universally seen as cons, right? Or drawbacks. So all of that needs to be vetted out. Typically, you're going to rely on an insurance broker to do that for you. In addition, the captive manager can also provide education, but of course, it's better if it's coming from the insurance broker. In terms of timing, our average turnaround is around 90 days. I think there's kind of a misconception that it takes a very long time to vet and join a captive. It really doesn't. If you're motivated and you're able to gather the information, moving through the underwriting process isn't all that difficult. There's a couple additional steps that are there that would not be there with, in comparison with like a traditional insurance marketing campaign, but it's not all wholly different. The output's different. The way in which the pricing is formulated and promulgated is different. So I hope that answers your question, Michael.
Yeah, I think that's helpful. And in terms of the folks who would be listening, I think it's important for them to understand. If it's, I guess I would look at it a different way. Is it much different than acquiring traditional insurance?
Yeah, so
I don't know if that's the right way to ask the question, but
it's definitely a great way to ask the question. So evaluating a captive and ultimately, let's say, joining a captive, it is a bit different than traditional insurance for a couple of reasons. Number one, it is a longer term decision typically, right? As I mentioned before, it doesn't have to be. There's nothing that says you need to join a captive for more than a year. It's on a 12-month policy period, right? But it's a decision with longer term implications typically. In addition to that, in terms of the differences, again, there are so many different captives out there to compare. You really want to, again, make a very comprehensive, or have your insurance person make a very comprehensive financial comparison that really takes into account all of the aspects, right? Well, because in a captive, there's a collateral component to this, right? And we don't need to get into every detail of it, but that's a financial lever that's there that may not exist in a traditional insurance program. There's the ability to be assessed in a captive, right? How do we factor that in? An assessment means like, hey, we had a bad year. We're going to owe money, additional dollars, just like a country club assessment. We may owe money. So again, it is different in that it needs to be more comprehensive to really capture all of the variables that would really drive an educated decision.
You mentioned earlier that you're able to leave a captive program. Is that, so it's a 12-month term, you can get out. Are there ramifications for leaving it? I get the impression, because it's you really have to go through a process to qualify, and then to turn around and leave it would be a tough decision.
Yeah, it's unlikely. Just statistically, it doesn't happen too often. I mean, particularly like after 1 year, just because the thought process is you've been educated, you join, you continue to learn more, you attend board meetings, which occur twice a year, and you essentially you really through osmosis you become part of the culture of the captive, right? And through participation. So as you build those relationships, it's unlikely. And again, there's a very high retention rate. Now, if you do leave, And let's just say, you had a $500,000 sitting there in, undistributed equity that was going to be due back to your company in the form of distributions. All of that money still comes back in the same time frame in which it otherwise would. You become an inactive member. If you do leave, you actually still have access to the board meetings until your captive cell is fully closed out. So it's not there's no punitive sort of action or consequences other than, hey, we're leaving the captive. We're going to place our insurance elsewhere, and we'll work with the runoff and get our collateral back over a 4 or 5 year period and so forth. And but yeah, not real common.
Okay. So what would you say are the primary benefits that captive members enjoy, a member-owned captive insurance program? And this is a two-parter. Are there any downsides to programs?
Sure. So the primary benefits really is if you're the right fit, 90 some percent of your premium and let's put it this way, your ultimate net cost, right? That's premium minus dividend plus risk sharing plus investment income, okay, is going to be driven by your own performance. So if you're entrepreneurial and you feel confident, you want to make a bet on yourself, that's probably the number one benefit. In addition, and this is feedback, of course, that we've received from our clients over the years, right? Because we're, constantly polling them, trying to gain insights. The number one reason, we hear that, hey, we wouldn't leave a captive is for the, monetary reasons. The second most common answer we hear is we would not want to give up the control that we've gained from a claims management perspective, right? So with traditional insurance, to contrast it for a second, you don't have much control because it's the insurance company's dollars. The contracts are structured where they have really kind of unilateral claim handling authority. So you're kind of just along for the ride. In a captive, it's set up with a third-party administrator that truly works for the captive. They're hired and can be fired by the captive. That drives a very different outcome. Entrepreneurs obviously like to have control where it makes sense to have control, and claims handling is certainly an area where it does. And then second part of that question.
It was, what are the downsides?
So downside, right. So there is, if you have a bad year in a captive, you will be in a position to pay up to a finite additional amount of premium. It's about 30% roughly. I mean, again, that's part of the evaluation process. You look at that. What I will say is, you don't get there with $1 million or $5 million claim, right? If you have that catastrophic claim, that is not going to wipe you out in a given year and create an assessment. The captive penalizes the members when they do not control the frequency of claims, right? So I mentioned earlier, the companies that control frequency do very well. If you have a ton of frequency in a year, that's where you can be in an assessment position and even max out your assessment. The other, which could be considered a drawback, is you are sharing risk. Typically, it's in and around the 5% of your premium range. So again, it's not an enormous consideration, in terms of the whole pie of your premium. That was something that, of course, you'd want to evaluate. Hey, historically, how has this thing performed? What has the risk sharing looked like? Because I'm joining a captive. These are all things you'd want to know, and of course, explore prior to joining. And you're posting collateral, right? With any high deductible type program, this isn't actually high deductible, but it's, kind of same concept, same theory. You are posting some collateral in the form of a letter of credit from your bank or cash. And of course, if it's cash, it sits in there and gains investment income as a long-term asset in your balance sheet. Or you're going to pay, a couple bucks or a couple percentage points typically for a bank letter of credit. So those are what would be traditionally seen as the drawbacks, I would say, and it's pretty universal.
Yeah. Well, in terms of, we talked a little bit about brokers before you brought that up. If I'm a construction company, what am I looking for in a broker to guide me through the process of evaluating these programs? And ultimately joining?
Yeah. So I would say, couple questions to ask. I mean, really, I think leveraging experience is really can drive very significantly better results than working with a broker that's kind of experimenting in this space. And that's not meant to be derogatory by any means, because some brokers are fantastic in the traditional space and not so much here. I think that's driven by their experience, by what type of clients they have. I think asking that question is a fair question. Asking, what captive managers they work with, where their clients sit and what types of captives. I think that's all fair game. And then also ensuring, hey, what does your evaluation process look like? Okay. Because that's really going to be the key, because at the end of the day, you're trying to just get to a very clear picture and a clear understanding of, this is one option, traditional insurance. This is another option, captive insurance. I want to be well positioned, well educated. I want an aggressive broker that knows what captive to go to, knows how to negotiate, understands how the pricing model is actuarially driven, because that just the understanding of it will create a better outcome. And then finally, how, again, going back to broker selection, what is the broker's kind of strategic holistic solution for my other lines of insurance that don't go into a captive, right? Because we've been talking about a group captive, and that covers primarily workers' compensation, general liability, auto liability, and auto physical damage. There's still some additional insurance out there for construction companies. Primarily, premium driver would be the excess insurance. And you need a broker that has a strategy for all of that, because if the captive works, but the excess insurance doesn't, well, the whole deal doesn't work.
I'm glad you mentioned the types of insurance. That was going to be my next question: is what are the types of insurance a captive covers?
Yeah, so it's those three lines of coverage. Workers' comp in most circumstances is obligatory. The other two lines of coverage, general liability and auto, are not. So it's any combination of those that includes workers' comp. Typically, we will put in all three lines of coverage unless there's a compelling reason not to, right? Obviously, that's part of the evaluation.
Yeah. We talked about collateral a couple of times. So regarding collateral, what are the requirements for putting up collateral?
Yeah. So broadly speaking, the need for collateral is there to protect from member to member, negative debt obligations. So if a member has a bad year, as I mentioned, and they have an assessment for $100,000, typically the captive is then going to allow that member to pay that over a 3-year period, the following 3 policy periods. But if that member just left the captive and said, I'm not paying that, I'm stiffing the captive with $100,000, the collateral is obviously the financial recourse that's there.
Right.
Okay. So that's the member to member protection. In terms of the amount, it's roughly speaking, it's going to be 70% of premium. Sometimes it can be more, and that's posted over a 3-year period.
Okay.
Right. So, again, part of the evaluation process, I think I'm kind of giving you a bit of a rough estimate on the percentage of premium there, but that's the function, and that's, typically the amount. And the other thing I would say, Michael, actually, I think this is important really for your listeners. So the other piece is, hey, how do I take a real quick look at my numbers, right? Meaning the premium that they've paid relative to the losses they've paid out, stratified to look back over the last 5 years. And had I been in a captive, would I have done well? Would I have succeeded? And will I be a fit? Right? We call that an equity analysis. That's another powerful tool because frankly, it takes our team or any broker that knows what they're doing. It's a report you can generate in a day or two, and it doesn't cost or it doesn't require a huge investment of time from your listeners, right? If they want to, prior to going through the full submission, the full Megiddo proposition of actually putting together a captive submission. And that's a powerful tool. We use that with almost every one of our prospective members before moving forward. And I neglected to mention that. And it's just a very quick way to say, look, this is what your numbers look like. It also illustrates roughly what their collateral expectation will be. And it will show, hey, you would have had a good year here. You would have won this year, lost this year. This is what your maximum will look like in a given year. So it also shows a lot of the financial attributes that are, pretty specific to that individual without having to, spend 2 or 3 hours digging up information. It's more like a 10-minute fact find.
Gotcha. We are getting ready to wrap up here. And I want to thank you again for sitting with me today and talking about this. Is there anything that that we didn't go over or that you want to mention before we call it a day here?
I would, again, I obviously, I'm in this industry. I've got a tremendous passion for it. We have over 500 clients in various types of captives. Would be very much happy to guide any of your listeners, have a conversation. We have a whole team at Assured Partners that exclusively dedicated to working with captives, and that's really A to Z. That's from the tip of the spear education to the member that's been in there 20 years, and we're just helping with day-to-day insurance needs and claims management. So I'd encourage anyone to reach out, and if it's not to us, your broker, again, I think. I hope I provided your listeners with sort of a baseline of what they want to ask their broker or brokers out in the insurance brokers out in the marketplace to ensure that they're working with somebody that can really guide them in a significant manner. And yeah, with that said, Michael, really appreciate the time.
Yeah, cool. Thanks for that. And just one last little plug here. Assured Partners is a sponsor of ASA. Is there anywhere you recommend that folks would go for more information about the company or about captives in particular?
Yeah. So, Assured Partners, Google us. We're a $3 billion agency. We've got, quite a bit of material there, material on captives. And then, of course, every engagement that we have is extremely specific to the individual client's needs. And but I will say the cornerstone is always going to be education, right? We want to educate, and we will spend painstaking time if needs be. And we're okay with it because we want to make sure that a new member really has a very good grip on a grasp on what they're what they're joining and for the right reasons.
Yeah, excellent. Well, thank you again for joining today. I think it's been very informative. I've learned a lot. I never knew about captives, so I consider myself educated, and I appreciate you taking the time.
Thanks, Michael.
Take care.
Thank you for listening to the ASA podcast. For more subcontractor-focused content, visit us at asaonline.com and fastcares.org. You can also follow us on LinkedIn, Facebook, Twitter, Instagram, and YouTube.